A very good morning to one and all my dear citizens. So hope your preparation, your academics are going very wonderful. All right. Now, in the previous session, we had finished circular flow of income from the chapter of national income and related aggregates. So we had prepared 5 questions. We had learned 5 questions. The very first was a quick summary that circular flow of income is a continuous flow of goods and services and corresponding flow of money income in a continuous manner. So the two principles on which the circular flow of income is based, the very first is that in a two-sector model, firms and households, the seller receive the same amount or the payment as the buyers pay. Then there is a continuous flow of goods and services in one direction and corresponding flow of money income in the opposite direction. So we had studied the entire circular flow, which has two flows continuously running, real flow and money flow. So what is real flow or actual flow or physical flow? The flow of factors of production from household to firm in the form of land, labor. So these are what households give to firm. They give land to the firms, labor, capital and entrepreneur. And in return the firms produce goods and services and give it to households. And then we also saw what is money flow or nominal flow. That is payment received from the firms by the households in the form of land gets rent, labor gets wages, capital gets interest, entrepreneur gets profit. And then a household spend the same income received by spending on goods and services, and that comes back to the firms. And this is how there are three phases where in income generation means that firms, they are utilizing factors of production, factor inputs to add value to goods and services. And then this is the phase where the income is generated in the form of rent to the land, for the land, wages for the labor, and same income they distribute. So this is here, the income is distributed, that is rent is given to the land provided by household, wages is given to the labor provided by households, then capital is gets interest, and further households spend on the goods and services, so they dispose the income by buying goods and services, so income disposition. Then quickly we saw the significance or importance of circular flow of income. So it helps us to understand the mutual interdependence, that all the sectors are mutually interdependent very strongly. Then helps the three phases helps us to measure the national income, that is value added method, income method and expenditure method. Last but not the least, how the savings results in leakages because it's a withdrawal of income from the circular flow, and how injections refers to addition of income to the circular flow. Example, investments. Now moving on to the most important thing, that is what are the basic concepts. So the basic concepts in national income. So the very first is, what is the difference between stock and flow? So stock refers to a phenomenon, at a point of time. It refers to, measurement of any variable at a point of time. Whereas the flow refers to a phenomenon over a period of time. That is when you measure a phenomenon or a variable over a period of time. Right. So stock, for example, if I say, the distance between, right, distance between Noida and Delhi, distance between say Noida and say you can take some Noida and say Rajasthan, right, distance between Noida and Rajasthan by road. But here it is the speed of car between the same, between Noida and Rajasthan, right? So this is stock and this is flow. Why this is stock? Because distance between Noida and Rajasthan is fixed, but here the speed of the car keeps changing. So this is one example. Then you can say wealth. Wealth is the stock, and the flow is income, GDP, right? So there were now wealth. If you say say wealth is at a point of time, but income keeps changing every moment, every hour, every day. The GDP, right? It keeps on adding. So income keeps changing. Then if I say, a 500 rupee note, or say 500 rupee note, rupee note. So here this is stock because it is fixed. A rupee note. So here this is one. But here you can say, then further, money supply. That can be one example. Then under stock, you can say, say capital. Capital. But here it is capital formation. Capital formation. Because capital formation depends on investment, which keeps on changing. So capital and capital formation. Then you can take a few more examples, population. Population as on say, as on today or any day. So maybe, for example, population as on say 31st December. 31st December. And here, you can take birth rate and death rate. It keeps changing. Birth rate and death rate keeps changing. So whatever the phenomena over a period of time, the birth rate and death rate, but the population as on 31st December. Then I can take, here a stock of mineral resources, and here it is exploration or extraction of resources. Extraction of resources. Now children, further, so you can go on and go on, So in your all competitive exams and in your main exams, what question you can be asked to identify the stock and flow. So I can give anything, production of sugar by sugar mills. I can give you, losses, profits. What is it? So flow. Profits, losses, that is also flow. So I can go on and go on, savings, investment, production, consumption. So identify stock and flow. So you have to prepare this topic accordingly. Then I can ask you, what is the relationship between stock and flow? So relationship, you can go on with so many examples in your daily life, from your daily life. For example, the stock of, the water in the overhead tank. The water has been stocked, but then after using, it flows. When you use, you use for cooking, you use for drinking, so the water flows. So over a period of time, that becomes, the flow of water becomes the flow. Then if I take an example of your, saving account. So, in my bank account, if I have say 5 lakh rupees. So, saving account deposit in a bank. So that is 5 lakh. So that is a stock. But suppose I withdraw 50,000. So that becomes flow. So withdrawal becomes flow. And similarly, if I deposit 10,000. So deposit also becomes a flow. So this strongly shows a relationship between stock and flow also. That is, the use of stock results in flow. My dear students, the use of stock results in flow. And the flow affects stocks. So remember two things. Number one, the use of stock results in flow. And the second thing is that flow affects stock. So in this way, you can go on with so many examples from your daily routine. So this is one thing, the difference between stock and flow. Now let's see the new thing. What is factor income and what is transfer income? Now factor income is the payment made for the services rendered. That is, if we make payment to the factors of production because they have rendered services in return. So in lieu of the services rendered, the payment made in return is called factor payments. So factor payment refers to, rent, wages, interest and profit and so on, right? So factor income is income that we pay, that we give out in lieu of the services rendered to the factor input. Now transfer income refers to it is not actually in lieu of rare services rendered. So transfer payment is something, the payment done or given out without any services in return, without anything in return, without any services in return. So without any, in lieu of, so say, you can say, examples if we talk about, so old age pension, for example, old age pension is one such case, old age pension, because it is given so that we take care of old people, the government gives to the old people, but there's no services in return. So for example, scholarship. Scholarship is another area. Scholarship paid to students. So students are not supposed to render any services in return. Then pocket money, received by you people from your parents. So parents don't tell you to, give anything in return, do services in return. That is another thing. If you do something with out of love and affection, then you can go on. Unemployment allowances in some countries. Unemployment allowance. Unemployment allowance. It is given by in some countries, where just so that the youth who is unemployed, the people who are unemployed, just to help them out. So these are the examples where no service in return, nothing in lieu of, right? Nothing in return. Right. So now why this question we study national income? Because in this, out of these two, only the factor income is considered when you measure national income. Only factor income. We don't consider transfer income because there has been no production in return. There has been no services in return. So that is the important why we see the difference between the national, between the factor income and the transfer income. Now coming to consumption goods and capital goods. So goods are the commodities and services for which we pay a price, right? We pay price for it. So for example, we don't, as of now, sometimes we don't include water, we don't include oxygen that we breathe. We are not paying for the free nature, the bounties of the nature. We are not paying for that. We enjoy when we are there in near trees. We take oxygen, right? We take the shelter of the trees. So these are called the goods for which we don't make payments, so that they are not categorized actually as those economic goods. So the goods can be of two types, consumption goods and capital goods. Now what are consumption goods? All the goods that we consume, that we buy for the satisfaction of our wants. That gives us the utility. So basically for the satisfaction of the wants. It gives us utility. Right? So consumption goods are the goods that are purchased. You can manufacture also yourself, but then you pay price for it, just that it gives you some satisfaction. So it is of three types. This is durable goods, then non-durable, and then we have semi-durable, semi-durable, right? Semi-durable. So now consumption goods. So goods, durable goods, you can take an example like we buy refrigerator, we buy car, water purifier, air purifier, all these goods, So durable is the one which you can use over a period of time again and again. So you can get services from durable goods again and again and again every year over a period of time. So durable goods are the goods which continue to give services, but non-durable goods are also called single-use goods. So non-durable goods are perishable, they are single-use, they get consumed and get finished once you use it. So bread, butter, anything, the services, so services which are consumed, bread, butter, and then so any example that is finished, the food, all the food. So non-durable goods are also, that is why they are called single-use goods, because they are consumed in one go. Then semi-durable goods, again the goods that less than durable. For example, clothes, they can run for 6 months, 1 year, 2 years, but durable goods goes on for 7, 8, 10 years, 15 years. So a little less than durable goods, that is semi-durable. Now what are capital goods? Capital goods refers to the goods that are used to produce other goods. So capital goods are the producer goods that are used to produce other goods. So machines. So capital goods are the machines, machines or fixed assets, you can say fixed assets, right? Plant and building, right? Plant and building, machines and all. So capital goods, these goods help a producer. So these are kind of producer goods that are used to produce other goods. Right. Now here comes one question. All producer goods, all producer goods are not capital goods. Discuss. So all capital goods are producer goods, but all producer goods are not capital goods. Right, children? So all producer goods are not capital goods. For example, raw material, they get consumed up, they get finished in the process of production. Electricity gets consumed in the process of production. There's so many examples, that get consumed in the process of production, right? So, but the capital goods, they are there for 10 years, for 15 years, right? For long period of time. So therefore, capital goods are producer goods, but all producer goods are not capital goods. So this is one very important question that can be that you should know in national income. Now capital goods further, now this difference is required because you have to understand further what do you mean by intermediate goods and final goods. Now coming to depreciation and capital loss. So depreciation is a concept that refers to normal wear and tear when the machine is being used. So when the capital asset is being used, a fixed asset is being used, it's a normal wear and tear. So we make provision for depreciation. That is called depreciation reserve fund. That is called depreciation reserve fund. So, we make provision for the wear and tear. So, it's, for example, if a machine is for 50 lakhs and, it gets, there's a tendency that it may run only for 10 years. So, what is the value then 50 lakhs upon 10 lakhs? So that means you have to make a provision for 5 lakhs regularly so that as soon as this machine is over, finished, you can immediately buy from that provision that you have made for. Right? So this is called depreciation reserve fund. Now depreciation has two components. One is normal wear and tear. Normal wear and tear. So what is the second one? Second is, foreseen obsolescence. Foreseen obsolescence. So foreseen obsolescence refers to expected changes. Expected changes in government policy, expected changes in market technology, the product technology, expected changes in consumer demand. So when you expect these changes, so foreseen obsolescence or normal and wear and tear is this. But then what is capital loss? Natural calamities, children. Natural calamities is capital loss. So natural calamities and unforeseen obsolescence, children. Unforeseen obsolescence. So you have the unexpected changes in government policy, unexpected changes in market demand, technology, and then natural calamities, they result in capital loss. So finally we narrow down to a concept called capital and investment. So what is capital? So capital is, children, the collected stock of goods or, in the, that has been, collected in the beginning of year. Right? So that is all added and results in in the beginning of year, the stock of good, it is called capital. So it is, accumulated stock of goods in the beginning of year. But what you add during the year is called investment. So for example, you all are sitting in a class of 40 students. So 40 desk and 40 chair. Last year it was a class of 40 students, 2020, 2021 class of 40 students. So 20 chairs and 20 desks. But now 5 more students have been added. 5 more students have been added during the year. So we buy 5 more desks and 5 more chairs and we include. So that is the investment during the year. So investment during the year, what you purchase and add is called investment. right? So the difference between capital and investment is very significant, because investment is something that results in capital formation, and investment is of two types. It is of two types. What are they? Investment in fixed assets, and then inventory investment. So, it refers to stock of finished goods, semi-finished goods, raw material, and then change in stock, that is closing stock minus opening stock. So, thank you so much. And in the next session, we take up the most important concepts further in national.